Now we come to a popular analysis of cash flow, call it sign pattern analysis. Financial analysts gain important insights by examining the sign patterns of the net operating cash flows, net investing activities, and net financing activities of a company. Now, on this part, this analysis, positive sign represents cash inflow, and a minus or a negative sign indicates cash outflow. By looking at the positive and negative numbers in this operating cash flow, investing cash flow, and financing cash flow, all business firms can be divided into 8 categories. So, in any given period of time, in any given year, for example, a company can be one of these 8 possible patterns or stats. Number one, or type 1 company, is when the signs are all positive, meaning the net operating cash flow is a positive number, the net investing cash flow is a positive number, and the net financing cash flow is a positive number. It means that's a company that's accumulating cash, and therefore its cash balance will increase. All the 3 activities, operations, investing, and financing, have generated cash. So it's a company accumulating cash, and it's generally interpreted as a company that is planning to launch a big project. On the opposite side is type number 8 company that has all negatives. Operating cash flows consume cash, negative sign. The net investing cash flow is negative also, minus, and the net financing cash flow is also negative. That's a company that is, as they call it, bleeding cash. Cash outflow, every activity of the company uses cash. So we need to think of where that money is coming from. That means the company is using up its cash balance. So it's a company that is dying slowly. Unless management makes a change in the company's direction, this company will not survive in the long. For type 2 company, the sum of the cash generated from operations and divesting activities are used to repay the debt. So we say type 2 company is a company mainly focusing on debt repayment or financial restructuring. Now come to company type 3. Type 3 has a positive operations, negative investing, and positive operations. Type 3 company is a company that has a profitable business in the sense that its operations generate net cash inflow, but it's also a growing company in the sense that it invests in assets. So its investing activity consume cash. So financing activities generate cash. Now type 3 company is called a growing company because money generated from operations and money generated from financing activities, either from borrowing or issuing shares, are both used for investments. Since the company is making huge investments, it's considered to be a company in the growing stage. We come to type 4 company. Type 4 company is a company that has negative net operating cash flow, positive investing cash flow, and positive financing cash flow. This company is a company that has an unprofitable business. Unprofitable in the sense that its operations use up cash. The company is not making sufficient sales, or its expenses are larger than its sales revenue. So operations produce loss. Now, how it covers or pays for its expenses? 2 ways. Number one, from its investing activities, company liquidates its assets to raise cash and uses that cash to cover the expenses or the operational loss. It is not enough. So they also borrow money. Financing activities generate cash. So the total cash generated from investing activities and from financing activities are used only to cover the loss of the company. Type 4 company will not last long unless the management team reorganizes its operations, meaning they should be more efficient, reduce expenses, generate more revenue, build good relationship with its customers to turn the operations into positive. Now we move to type number 5. Type number 5 company is called a cash cow company. It means this company generates net positive cash from its operations and uses that cash for investments and for repayment of debt and dividend payment. Operations produce positive cash flow for type number 5 company. Now it uses those cash from operations for investments. That's why the ICF investment cash flow is negative. It's expanding and it generates more cash from operations and therefore uses some of the cash for debt repayment or dividend payment, meaning the financing cash is a negative number. We move to company type 6, which is also an unprofitable business. From the chart, you can see that company 4, company type number 6, type number 7, and type number 8 have all one thing in common, and that is they have unprofitable business operations. OCF is negative. Management of type number 6 company liquidates the assets of the company to generate cash that will be used to cover the expenses or to cover the operational loss and also use the money for debt repayment. So operating cash flow is negative, financing cash flow is negative, the money used for covering the loss and repayment of debt or dividend payment comes from the liquidation of assets. Now we move to type number 7 company. It's also a loss-making company. It's also growing company. It's investing money. Where does the money come from then? Since it is making loss and it's also growing and buying assets, the money comes from external source. It's a company that is borrowing money to pay for its operational loss and also for expanding the business. That does not make sense. It will not last long because the debt level of the company is rising. It's using external funding. It's borrowing money to pay for its expenses and for also investments. That is not a sustainable situation. The proper action for the management is to restructure the business, launch an effective marketing campaign, cut its costs to turn its operations into positive. The final type of the company is type number 8. This is a company depleting its cash balance. It is losing money or spending money in all the 3 activities. Operations is negative, investing, and financing. So where does the money come from? That is used for covering the loss, making investments, and debt repayment. The company's business is not generating money. It's rather using up money, and the management continues to make investments in the business and also repaying debt. That money is money saved from the previous years. The company is using up its cash balance. That is not also sustainable because the company will suffer liquidity problem. Now, we take a look at the statement of cash flow of this company, PCP, and we want to find out its sign pattern. You look at the net operating cash flow line, it's positive. You take a look at the net investing cash flow, it's negative. And the net financing cash flow is positive. So the company's sign is plus, minus, plus. You compare that to the table, it turns out to be type number 3. Type number 3 is described as a company that has a profitable business and growing. Type number 3. So we have identified that the company is type number 3 for the year 2023 because it has positive, negative, and positive. It means it's a business that has a profitable operations. Operations are making money, but because it's growing and therefore makes large investments, internally generated cash is not sufficient to cover the investment needs. So the company also uses external financing. It is borrowing money and using the money borrowed and money generated from operation is to expand the business by making investments. Now, if you look at for the year 2022, the company follows in sign number 5. That was a cash cow company. If you compare both, we recognize that in 2022, the company was a cash cow business, but in 2023, it started growing. So it's a growing business and making value for its shareholders.